特朗普嘅第二任期已經過咗4個月，各種彈弓手嘅經濟政策令全球市場好似坐過山車一樣。一方面，特朗普堅持對全球佔美國便宜嘅國家大徵關稅，又要求聯儲局盡快減息；另一方面，又不停話要削減財赤、縮減開支，但近日又繼續推出 Big Beautiful Bill， 要求大幅減稅。資產配置諮詢公司 Gavekal 共同創辦人兼行政總裁 Louis Vincent Gave 近日就同我哋傾到最近嘅中美關稅博弈，同埋分析大家關心嘅美債、美元下跌、貿易戰走向，同埋佢對中國最新經濟數據嘅一啲睇法。
Let's dive into the biggest drivers of the recent market turmoil, which is obviously the US President Donald Trump's trade policies. The 90 days pause is actually halfway through already. It seems that only UK had struck a deal with the United States and other major trading partners like Japan, Mexico, South Korea. The negotiation is still stalled, it seems. So how do you see this prospect unfolding?
Well, first, welcome to our new office. Look, to your point, I think one of the big challenges apparently that most countries are facing is when they turn to the United States to negotiate, to say, okay, what is it that you do want? There's not a lot of response, not a lot of feedback. And I think that reflects several things. The first is that the Treasury, the Commerce Department, the USTR offices are not fully staffed yet. You know, it takes a while for an administration to get deputy Treasury secretaries, deputy Commerce secretaries. So that's the first challenge. I think countries, whether it's Mexico, whether it's the European Union, whether it's Japan, whether it's Korea, they might not have the right conduits into the Trump administration, number one. So that's the first challenge. I think the second challenge, when countries such as Japan, such as Korea, such as the European Union go to the United States and say, okay, what is it that you want? Very often, the other side, the United States, says, well, what is it that you offer? And so it's a little bit like two deaf people talking to each other. And yeah, we're really, it feels like we're not going anywhere. Having said that, given the lack of progress, I think what seems the most likely is that, you know, the 90-day period will be extended another 90 days. It'll be just like TikTok. You remember when President Trump was elected, he said he would, you know, put TikTok into a U.S. sovereign wealth fund and he would take care of it in the first week. And here we are months later, and every 90 days, TikTok in the U.S. gets another extension. The odds are it will be the same for trade. It will be the same for trade because while the 10 to 20% tariffs that most countries have disrupts trade somewhat, it isn't going to collapse growth. But if you increase the tariffs from here, that would be quite problematic for U.S. growth, for other countries' growth. And I think the sell-off in equities, the sell-off in bonds that met the Liberation Day tariffs was a bit of a warning sign for the administration.
The Geneva meeting between the US and China's trade representative, actually it was quite a surprise that China agreeing to lower the tariffs to 10% and US to 30%. Do you see that as a strategic retreat for Trump administration, or is it a genuine opening for negotiation for both sides?
I actually think it's perhaps the latter, or maybe it's me wishful thinking, and I hope it is the latter. Because if we stay at 30% tariffs on China, even 40% depending on the goods, even 40%, it's going to impact US growth. It's going to impact the US consumer. It might lead, in fact, to even bare shelves in stores. So I want to hope that it's the start of a better relationship. Now, one of the reasons I hope it's the start of something better is that if you look at that 30% that you mentioned, it's essentially the 10% that everybody got, plus the 20% for fentanyl, because the US says, look, China sells all the precursors for fentanyl to Mexico, and then Mexico makes the fentanyl drug, and then lots of people die in the US. And the fentanyl is a real crisis in the United States. you have about 80,000 deaths per year. To put things in context, in the whole Vietnam War, the US lost 75,000 people. So every year, the US loses more young men, because it is mostly young men, more young men to fentanyl than it did to Vietnam. So you could see why Trump would want to be seen to be doing something about this. Now, of course, blaming China is the easy path. It's to say, oh, we have a fentanyl problem, not because we have young people taking drugs, but because China sells those drugs. So it's an easy path for the US administration to deal with. Having said that, so he wants to be seen doing something. So he says, okay, I'm going to ask China to stop selling the precursors to Mexico. And if China does that, and that's a very small business for China. So China could say, okay, fine, we stop selling the precursors to Mexico. And then the US brings the tariffs back to 10%, at which point, 10% isn't that big a deal. We could have another positive surprise in the coming weeks and months with tariffs going from 30 down to 10. Now, of course, this will most likely happen if inflation in the US is high or if you get supply chain dislocations.
But what if the US retains the tariff level at about 30%? So what would be the minimum economic impact on both economies?
It's a hard one to judge, partly because this is very sudden, very hard, very big numbers in a way that we haven't really seen since the 1920s and 1930s. Now, back then, our economies were far more agricultural and manufacturing. Today, our economies across the world of services are very often a bigger part. So it's there's no real historical precedent for this. My own inclination is it'll obviously hurt both economies. Look, tariffs at the end of the day are a tax increase, and like every proper Hong Konger, I tend not to like taxes. And so any tax increase usually means lower growth. It means misallocations of capital, and tariffs are no different. And so I tend to believe that these tariffs will hurt U.S. consumption, number one. Number two, they'll hurt capital spending everywhere. They'll hurt capital spending in China. They're going to hurt capital spending in the United States because of the level of uncertainty that all of it, and they'll hurt capital spending everywhere around the world. Who today in their right mind builds a new factory? And where do you build it when you don't know what the tariffs are? If I'm producing shoes for Nike, do I build my new factory in the US or in Vietnam or in China? It's right now, the safest thing is to say, I'm going to wait and I'm not going to build a new factory. So I very much worry that all these tariffs are going to lead to weaker growth, both in US and China.
But to be honest, some analysts would say that Trump actually blinked because of the bond market's pressure, not the inflation or the economic situation. What's your take on that?
A good friend of mine says about Trump that it's the taco trade. And the taco doesn't stand for a Mexican dish, but for Trump always chickens out. And I think there is some truth to that. I think the US blinked because essentially I tend to believe that Trump follows policy a little bit like he gives his speeches. I don't know if you ever watched his speeches on TV, but during the campaign he would go to these rallies and he would stand for 3-4 hours and talk about lots of things, which is pretty impressive for a guy his age. He would command the attention of the crowd for long periods of time. And what he would do, he would come in unprepared, no notes. He would start talking about something, and if he can judge very quickly if the crowd likes it, then he does more of that. And if the crowd doesn't like it, he drops it and moves on to the next thing. And I think he does policy in the same way. So he tried on the tariffs, and the bond market didn't like it, the equity market didn't like it, his big donors didn't like it, his voters didn't like it. And so he switched. He said, okay, I'm going to stop talking about tariffs, and I'm going to start talking about tax cuts. And so for the past few weeks, it's all been about the big, beautiful bill going to Congress, and it's been all about tax cuts. Now, suddenly, he revived tariffs again by putting in the 50% on Europe, and the market again didn't like it. So the equity market kept going up, and he put in the 50%, and immediately the markets seemed to stall. Yes, I agree with you. I think that his ability to keep imposing tariffs is limited, and yes, perhaps not by the equity market, but by the bond markets. The US has a lot of debt to roll over, and this year we'll be running a $2 trillion budget deficit. So the rate at which this debt is issued does matter.
Actually, China has taken a firm stance since the Liberation Day, which is pretty different from how they dealt with Trump first term, right? So how well do you think China is performing since April 2nd? And do you think China has gained an upper hand so far in this phase of trade war?
Yeah, I think, when you look at how China responded, I think it was the result of a few things. And yes, you're right, it responded very differently than when it did the first time around. I think the first reason was intense frustration. I think when President Trump came in, Beijing, Xi Jinping, the CCP, tried to get in contact several times with the Trump administration to discuss things, even including after the imposition of the fentanyl, the extra 20% that was put in on like day one or day two of the Trump administration. The Chinese government kept trying to reach out to the Trump administration and never getting a response. So I think a lot of frustration had been building up. So that was the first problem. The second problem, I think, if you were China, is by the time the tariffs came out, and China was essentially getting charged 30, 40, 50% depending on the goods. So this was going to have an economic impact regardless. And so, then the government was left in a position of, do we take it on the chin and not respond? Or politically, for our own people, we have to be seen to be fighting back. Clearly they chose to fight back, which perhaps was the right response, because now they've essentially, at the very least, gone down from roughly 50 down to 30. So the outcome is somewhat better. And like I said earlier, there is still the possibility that you get rid of the last 20% of fentanyl and you end up at 10%. Now, if you end up at 10%, which is a big if, but if you end up at 10%, the impact on the Chinese economy will be very modest. It really won't matter very much.
Let's move on to talk about China's latest April economic data. Looking ahead, China's April data showed manufacturing PMI dropped to 49, which signals contraction, despite we can see that the Q1 GDP growth is like 5.4%. Are you concerned about this PMI decline that may point to a deeper vulnerability in China's manufacturing?
So that's a great question. So what's interesting is that wherever you look around the world, and China is definitely an example, but the same is true to some extent in the US and Europe, etc., is you've seen the soft data, essentially the surveys. And you mentioned the PMI. The PMI is a survey. They go out and they ask a bunch of CFOs everywhere and CEOs everywhere how their business is doing. And the soft data everywhere, whether consumer confidence, PMI surveys, business confidence, all the numbers almost everywhere in the world are pretty poor. The hard data, meanwhile, is more mixed. And the hard data being things like retail sales, being things like industrial production. That is not as bad. Now, very often in any economic cycle, the soft data turns around first. So before you get to a recession, your PMIs go down, your consumer confidence go down. But it's not because these things go down that you will end up in a recession. So here we are at an interesting point where surveys are bad, and we know why they're bad. The news flow has been terrible. If you're a business today, like I was saying earlier, you have no clue what is going to happen 12 months from now. So you're not very likely to invest very much. So you've got that overhang, which is undeniably there. Now, if tomorrow let's say we get rid of the fentanyl tariffs and you move back to 10 or 20% tariffs, I would expect the PMI surveys to come right back. So I think for now we have to assume that the PMIs are probably right. We're going to see less capital spending, less employment, less growth, and this puts the onus on the Chinese government probably to do more stimulus and to perhaps spend a little more at both the central and the local authority level to prop up the growth.
Right. Do you think the consumer demand is also an alarming issue in China right now? Because we can see that the retail sales growth slowed to 2.3%. Yeah. Do you see this as another warning sign for China's economy?
Look, I think it's been tough being a consumer in China, right? In recent years, confidence has been crushed, mostly because most people have most of their wealth in real estate in China, and we've had a 3, 4, 5 years real estate bear market in most of the major cities. Now, the good news is the real estate bear market might be coming to an end, thanks in part to lower interest rates, thanks in part to slowly rising incomes and property prices that have come down. The affordability ratio in China today is as good as it's been in 20 years. Now, a lot of that has been the falling interest rates, but the cost of servicing a mortgage in China has gone from roughly a third of the median salary 5 years ago to just a little over 20% today. So if real estate is bottoming, then consumption should start to do better. Now, on this note, we're taping this in late May. We a couple weeks ago we got all the data from the May Golden Week. May 1st and Buddha's birthday, and so it's a big week. The first week of May has a lot of people are on holiday, and what was quite encouraging is the internal tourism numbers in China have never been this strong. You had 6.9% year-on-year growth in the internal tourism data, whether you looked at train tickets being sold and plane tickets being sold and hotel bookings. And so the reason I find this encouraging, 6.9% year-on-year growth in tourism spending relative to the 2.5% in retail sales, is that tourism is one of those things. You don't need to go on a holiday. You don't need to go do tourism. It's one of those things you do when you start to feel better, when you start to have a little more money in your pocket. You might say, okay, let's go on a holiday. Let's go visit Beijing. Let's go visit Shanghai. Let's go visit Guilin. So the fact that the tourism numbers were at record highs gives me some comfort that A, the Chinese economy is not imploding, and that B, that the worst for the consumer may be behind us.
Let's move on to talk about EU now. President Trump actually has imposed a 50% of tariffs on EU products last week, and he even declared on his Truth Social post saying that the bilateral talk is going nowhere. And just today he extended the deadline to 9th of July, just a month to go. Is this escalation enough to force EU to rethink its strategy to negotiate with the US?
So it's a tough one because yes, it's not obvious, as we were discussing earlier, it's not obvious what the Trump administration wants, first of all. One of the things that the Trump administration wants is for the EU for EU countries to get rid of their VAT. That's a real problem because for a lot of countries, the VAT is a huge part of how the European welfare states fund themselves. And you can't really ask a whole other part of the world to completely reorganize their tax system. So that's your first challenge. I also think that within the EU, for democratically elected officials, you just don't want to be seen giving in to Trump. I think that the lesson of the past couple elections we've seen in the Western world, most notably Canada and Australia, is that if you're perceived to be an ally of Trump or a friend to Trump, you're going to lose the election. So whether you're a Swede, a German, a Frenchman, today you don't want to be seen to be caving into Trump. So Now, going back to your 50%, it's pretty obvious that this was a tariff, like it was a negotiating ploy. You know, Europe and, to your point, Europe and the U.S. have started, you know, another round of negotiations. So Trump puts, I think, the 50% out there to essentially scare the Europeans during the negotiations and force them to compromise. The reality, however, is, you know, Europe is an important economic bloc. It's a tough one to manage because, unlike China, the power is very diffuse across the European continent. So I'm skeptical on a deal being done. But having said that, Trump isn't going to impose 50% tariffs because that would create big supply chain dislocations in the United States, and the financial markets would hate it.
Do you think that actually it would push the EU to retaliate, just like China, how China did?
I'm not sure it will, partly because, remember, the EU mantra, the sort of backbone, is actually quite free trade-ish. Like the whole point of the European Union, it started to promote free trade within the Union. And so there's a big part of the European Union, whether the civil servants who work in Brussels, but also a number of countries within Europe who are, you know, very free trade oriented. And, you know, if the US wants to impose tariffs, then that's the US's problem. It doesn't mean that, you know, Europeans, and I say this as a Frenchman myself, that we have to punish ourselves and punish our consumers by charging higher tariffs. So I'm not sure the EU will retaliate massively.
But what would be the concessions that EU can realistically offer to avert the trade war, and how much leverage the EU has?
I don't think the EU has tons of leverage. You know, what concessions they can, well, I mean, some are easy. Like, for example, getting rid of the tariffs on automobiles. You know, Europe has tariffs on automobiles, and that gets President Trump very worked up. Now, the reality is you can get rid of the tariffs tomorrow. Europeans are not going to buy big Chevy Suburbans or Ford F-150s. These cars are too big for European streets. It's not going to happen. They're also gas guzzlers, and gas in Europe is much more expensive, so on and so forth. So I think there's small cosmetic things like this that Europe can do, which then allows President Trump to declare victory. So to the extent that Europe can give Trump some wins without too much cost domestically, that's, I think, the path will go down. Now, concretely, does that mean a big shift in the economic relationship? I doubt it.
So let's talk about the U.S. government debt situation and the bond market.
Oof, let's brace myself.
The U.S. Treasury projects the debt limit X day will be arriving in August. Also, there will be a significant Treasury debt that maturing in June next month. So do you think that that will be a routine debt ceiling increase? And other than we would see something like more like significant disruption happening this time?
We'll get the debt ceiling increase because we always do. But more importantly, you know, the Republicans are usually the ones who fight debt ceiling increases. But they only fight it when there's a Democrat president, not when there's a Republican president. So yes, we will get the debt ceiling increase, and that'll be that. Now, the reality is that yes, the U.S. has roughly 37 trillion of debt, U.S. dollar of debt outstanding, trillion with a T. That in the next couple of years, it needs to roll over roughly 9 trillion U.S. dollars. And then it also adds roughly 2 trillion a year through the budget deficits. So, you know, in the coming months, the U.S. probably has to roll over roughly 6, and then an extra 2 on top of it. You know, how does it do that? Well, especially if at the same time it's making the debt less attractive to foreigners by, you know, essentially talking down the U.S. dollar, by bashing foreigners. So the answer is severalfold. First, you can roll over at the short end. which is what Janet Yellen, incidentally, has been doing in recent years. Is if I can't go out and issue very long-dated bonds because the yield is too high, I'll issue short-dated bonds. So that's, I think, number one, what they're doing. Number two, I think what they can do is embrace financial deregulation, and that's what they're doing today. Embracing financial deregulation, and in so doing, giving the commercial banks the ability to buy more bonds. And we're going to see this. We're about to see a wave of financial sector deregulation, and without banks, insurance companies will be able to buy a lot more bonds going forward. And I think this will be probably enough to fund the budget deficit for this year and next year.
Something also happened lately is the Moody's recent stripping.
Yes.
The
AAA.
Yeah, AAA of US, which is the last AAA credit ratings.
Well, look, a downgrade is never great news, right? You'd rather always get an upgrade saying, hey, you're doing a great job than, hey, you're doing a bad job. Here's a bad grade. So it's not that great. Having said that, I think that for sovereigns, for individual countries who issue debt in their own currency, the downgrades don't matter very much. The upgrades, the downgrades, they don't matter for the bond markets. They might matter for the currency. Because if you're the United States, you can always pay your debt back because you've got a printing machine that prints US dollars.
Yeah.
So I think what Moody's is telling the world is, look, if you're buying US dollars today, you're going to get paid back in monkey money. You're going to get paid back through the printing press. So it's not that great an investment. And I think Moody's is right. And so for me, the Moody's announcement is perhaps more bearish on the US dollar than it is on US bonds themselves.
How would you comment on the investor confidence for the US assets or bond market right now?
Look, the US has been such an outperformer for 15 years. And I know everybody's running around today saying, oh, US exceptionalism is dead, etc. I've been doing the same. But the reality, to your point on confidence, US has been such an outperformer for so long that the default mode with people is still to think, oh, I need to buy the dip. Oh, Microsoft is down 10%. Great opportunity for me to buy. So the US runs twin deficits of 11% of GDP. The US keeps on pushing dollars abroad to the rest of the world. And the default mode of the rest of the world for years was to buy US treasuries with these excess dollars. Now it's probably, in recent months, it's been to buy US equities. But, I think we're coming to the end of that.
But do you think the acceleration of the dollarization is happening? I do think more trade is being denominated in currencies other than the US dollar. Look, it's pretty simple. Today, the industrial powerhouse in the world is China. And there's no doubt that China is trying to fund more of its trade away from the dollar. If you're China today, you have essentially, what are your choices to fund your trade? You can fund your trade in US dollar, but then that makes you a tributary to the US Treasury. You can fund your trade in renminbi, but then at some point, that would entail that you're going to have to give up capital controls, which China doesn't want to do. You can fund your trade in renminbi and make the renminbi convertible to gold, which is what China's done. And the more Chinese trade grows, the more the demand for gold goes up and the gold price goes up. There's a fourth option for China. China's unique in that it's one country, two currencies. And so conceptually, China could fund all of its trade in Hong Kong dollars. It'd be like the Chinese currency. You'd have the Chinese currency for home, which would be the renminbi, the Chinese currency for abroad, which would be the Hong Kong dollar. And here we get to something called Gresham's Law. Gresham's Law, which is the good currency, the bad currency chases out the good one. If you're China today, you're accumulating all these dollars, but you don't want them. So why not send them to Hong Kong, have Hong Kong create Hong Kong dollars, and fund your trade through Hong Kong dollars? I think this is just starting. I think this is why you're starting to see a lot of excess liquidity in Hong Kong.
right now, HIBOR rates, the difference between US interest rates and Hong Kong interest rates has never been this high, with Hong Kong interest rates far, far below US interest rates, which tell you there's excess liquidity here in Hong Kong. And so, putting all this together, I do think, we are gradually moving away from the US dollar, but this is going to take a very long time. It's going to be a process. There's not going to be a date where we're going to wake up and all of a sudden the US dollar isn't there. The US dollar is still an integral part of the global financial architecture. It's just that people are chipping away at it a little bit.
I want to refer to one of your interviews that you did with US media in March. You named it 3 things that Trump truly wants, which are lower bond yield, lower dollar, and lower oil price.
He's got 2 out of 3 so far.
Yeah, I mean, lower bond yield is definitely not achieving. What about the other 2? How do you comment on that?
Yeah, so the first, the lower dollar, if policymakers want to weaken their currency, usually they can. It's hard to strengthen your currency, but if you're really committed to weakening your currency, it's possible. Now, one of the ways to weaken your currency is to make it less attractive for foreigners to be invested in your country, and then foreigners leave and your currency goes down. This is what we've seen in the US. Lower energy, this has always been baffling to me because it's so, economic activity is energy transformed. So it's so obvious to me that the goal of every elected official should be getting cheaper energy. You get cheaper energy, people like you. You make energy more expensive, people don't like you, and you also get less growth, less job growth. So for me, what's been fascinating in the past 25 years is how few politicians out there say, hey, let's get cheaper energy. So many politicians say, oh, let's push up the price of energy so that we can have the energy transition. So that we can, move towards more solar, move towards more wind, because unless we make energy more expensive, nobody will want to switch. So to me, that's sort of political suicide, making more energy more expensive. You want, as a politician, you want the cheapest energy possible. So I'm not surprised that Trump, went down this path, and so far he's been successful. Oil has gone from $70 to $60. Whether it stays there is a big open question. I personally don't believe it will. I think it's going to come back and be at $90 in no time.
But his aim should be like 40 or 50.
Yeah, if he get well, I'm not sure it should. Well, you're right. Maybe it is his aim, but he should be careful what you wish for, because the problem if you go below $60 is a lot of companies in the shale oil patch go bust. A lot of companies in Texas, a lot of companies in North Dakota, companies in Colorado, New Mexico, and Louisiana. Below 60, the energy industry really, really struggles. Yeah, look, the yields, they came in, they being Trump and Musk and J.D. Vance and Scott Bessent, they came in talking about wanting to bring yields down. And it was Doge, and we're going to cut government spending, and we're going to cut government borrowing, and Doge is going to have between $1 and $2 trillion of savings. And then here we are a few months later, and essentially what Scott Bessent is now saying is, we're just going to grow our way out. We're going to do the big, beautiful bill, we're going to have bigger budget deficits, and we're going to grow our way out of our borrowing needs. Now, the problem with that is that that's a message the bond market does not like. Because really you're left with 2 options. You're left with, one, it succeeds, and then why would I want to be in bonds? There's lots of, if the US economy is going to be booming, there's lots of better things to own than bonds. Or 2, it doesn't succeed, in which case, I'm stuck with a bunch of bad debt. So I think today the message from the administration is not bond friendly at all.
Because they are definitely going to push forward the tax cut, I guess. Yeah. And the bill is project to add at least $3 trillion to US debt.
Yeah.
And one very interesting thing is the Nobel Prize economist Paul Krugman has recently compared the US situation to the UK's situation, Liz Truss mini-budget crisis.
Yeah.
Would you agree on that? Do you think America would face the Liz Truss moment?
I think there was a possibility that you would, following the Liberation Day tariffs. It felt very Liz Truss-ish, with collapsing exchange rates, collapsing bond market, collapsing equity market. it felt very dicey. Now, the U.S. of course is a much bigger, more resilient economy than England, than Britain. Not only that, the reality is that there's always a price at which people will buy U.S. assets because it is the number one economy in the world. It's massive. So if things get cheap enough, people will buy U.S. dollars. People will buy bond yields. So this doesn't mean you can't have a Liz Truss moment of panic on the bond market. And look, you've had panics on the bond markets for the past 50 years. Not on a regular basis, but you've had big bond market crashes. You had one in 1994 and 1995. Goldman Sachs almost went under back then. The partners had to re-up capital to recapitalize Goldman following the big bond market crash of the mid-90s. Is that possible again? Absolutely. And this wouldn't mean that all of a sudden the system implodes. It's just, it's just the way it is.
Do you think the Japanese bond market is more important issue right now?
I think I don't know if it's a more important issue, but it's a very important issue. It's a very important issue because, Japan has been a huge provider of net savings to the rest of the world. So as JGB yields come up, the incentive for Japanese savers is no longer to push money abroad, but to keep the money in. And so I think that's number one. Now, why are JGB yields going up? Simple, because Japanese inflation is going up. Japanese inflation is now 3.5%. In a 3.5% world, who in their right mind would want to lend to the government at 1.5 or 2%? So if inflation is 3.5 in Japan, bond yields should be at least 4, if not 4.5, and I think that's what's happening right now.
So as we wrap up, let's look at what investors should be watching forward. What upcoming events that would be most important in the coming few months maybe? Do you think it's the trade deals, the debt ceiling, or Powell?
I don't think it's the debt ceiling because that's always sort of shadow theater. So I don't think it's the debt ceiling. I think the trade deals do matter. But to be honest, I think it's whether the Fed cuts or not in September. The market is now pricing in for the Fed to start cutting this fall. And I think if the Fed, right now, if the Fed doesn't follow through, you could have a big snapback in the US dollar and potentially even a rollover in yields. If the Fed does follow through, then we'll have a nice steep yield curve and the current outperformance of banks everywhere will continue. Now, I think the Fed will follow through. I think the Fed will be cutting interest rates. And to me, that perhaps matters more right now than all the noise on trade, partly because the noise on trade changes every week. It's like it's selling this week, it's selling next week. So it's hard for you to build portfolios around it.
Okay. It's a pleasure to talk to you, Louis.
Thank you very much.
Thank you very much.
Thanks for having me.